I'm joined now by Puneet Chhatwal, MD and CEO, IHCL. Mr. Chhatwal, a very good morning and thank you so much. Great to have you on NDTV Profit. Tamanna here. So I'm going to start by asking you, if I were to want to book any kind of property right now for the New Year's weekend coming in at any of your properties, would there be space available or are you jam-packed?
Wow, it depends, you can always give me a call if you're not making progress. But yes, there are spaces available. It's always a question of price, destination, and connectivity. So I think, but the sector is doing very well,
Yeah.
and the occupancy levels are very high, and that allows us to have a higher ability to charge.
So the question was to get a sense of what this period is looking like for IHCL and for the industry. How much higher are the rates and what are the kind of occupancy levels we're seeing over these 2 weekends and this entire Christmas New Year's period?
See, there is an increase year to date over the previous year in a double digit, depending on which brand and which locations. All markets are almost in higher double digit growth, 12, 14, 17, 18%. And very important, most of this growth is coming through higher average rates, which would obviously increase profitability. So that is generally for the sector. For us, we have already declared the first half results, which were, indicative of 30% more profitability versus the first half of last year. And given what we have seen in October, November have gone very well, and December year to date is looking also very good. And each day between today till the 1st of Jan is high revenue. And the question is, how high will it be based on the business on books as well as the pickup? We remain fairly optimistic that we will finish the year on a higher note, and also with very good rates, good occupancies, good wedding season. All in all, very, very positive.
So Q3 traditionally, Mr. Chattwal, is a great quarter for the company, and you saw Q2 looking robust but a little tepid compared to Q1. Can you give us a sort of an overview of how you're looking at the second half workout and what are the standout sort of numbers you're seeing in Q3?
Well, Q2 is the weakest quarter traditionally, but we still had a big increase in all, revenue, EBITDA, in margin, and in profit after tax. Q3, as you rightly said, is the strongest quarter, especially for us because we are a very well-hedged portfolio. We have a right balance of resorts, especially with the Taj brand, which is the backbone of the company, and also business hotels. So I think till the 15th of December, business hotels do very well. And in between, the festive season of Diwali and other holidays, and then the Christmas and New Year, the leisure hotels tend to do very well. So our palaces in Jaipur, Udaipur, Falaknuma in Hyderabad, or our resorts in Goa and Kerala, this is their time. This is when they charge the highest. This is where it is very difficult to get places, including in our homestays. From what I heard this morning from my colleagues, all our homestays under the brand name Ama are sold out in Goa. And we're trying to finish 4 bungalows actually today so that we can open them tomorrow and accommodate more demand.
That's crazy. We've been hearing about these stories, highways jammed, people flying into Goa and other tourist destinations. So definitely the appetite is there. The question is about sustenance and what it turns into in terms of figure. So if I were to ask you, Mr. Chattwal, for your outlook in H2 for your ARRs, revenues per customer, EBITDA margins, are you on track? What are the kind of numbers that you're foreseeing?
Currently, Tamanna, we are ahead of our guidance. I see no change than what guidance we have given for like the short term till 2025 under our strategy Avant 2025. that is of 33% EBITDA margin, approximately 300 plus hotels, which we actually increased to 325 by the time we finish 25-26. So we are very much in track, but more important is to understand what you said, sustainability of this kind of development in revenues, occupancies, and margins. There is a shift in this sector. This is not anymore, like a luxury or a sector just driven by, volatility and cyclicality. There is cyclicality. However, travel has become a need, a fundamental need, because you're traveling to tier 2, tier 3 cities. Everywhere there is infrastructure development, people need to sleep somewhere, right? So 90% of the supply in India is non-luxury supply, and that is also fueling demand going forward. The number 5 economy in the world with aspiration to become number 3 will bring certain structural changes and a certain shift. And I am very, very confident that this sector starts moving more and more towards a consumer sector than just a leisure, discretionary, and a luxury sector. So, and we see that. We just opened our flagship property in Santa Cruz, the Ginger. It's not even 1 month in operation, and the way it is performing is extremely different than what we are used to 120 years of Taj. So this change is happening as we speak, and this is very good news for the hospitality sector. The supply will remain constrained, demand will show 8 to 10% increase per annum, and that would mean that your ability to charge would be higher and your ability to drive profitability and good margins is higher.
Strategically, are you focusing more on the non-luxury space going forward?
No, it would be not prudent to ignore our flagship, our crown jewel, not just for us, but for the country, that's the Taj.
Yeah.
However, we have divided recently our traditional businesses, that's Taj, Vivanta, and our platform of selections, and new businesses under a new head for which we call the reimagined Ginger, Ama, and Cumin. And we want to scale up these businesses very fast so they start becoming 20 to 25% of the total revenue of the company. This also includes certain initiatives like our private membership club, chambers, which we are scaling up. It includes certain standalone restaurants, as well as, I would say, a lot of focus on the reimagined TajSATS flight kitchen business, which is currently having more than 50% share of all the meals served in the year. So I think from a diversification of top line, from a diversification of brands, and from the sources of income, we are a very well hedged portfolio, whether we talk of brands or we talk about leisure, business hotels, national, international. Somebody is always doing well, and some places are not doing so well, and so it all balances out. But especially the Taj continues to outperform its entire comp set.
Puneet, good morning, Neeraj here. Must say, compliments. I just came back from a Taj stay in Jodhpur. It was fantastic. I visited your Taj 3s at Vikhroli. Very, very cool. I wanted to ask you 2 questions specifically. One, you mentioned Taj stats, and I remember in a conversation that we had earlier, the conversation was that room rates now don't account, I mean, they still account for a majority, but they are no longer such a vast dominant in your overall scheme of things. When we were talking about 2023, I understand from a 45-55 ratio that I presume was there, how do you anticipate 2024 and 25 to be when it comes to the split between the different business lines of IHCL?
We are very blessed to have very strong food and beverage business in the Indian subcontinent. So if you look at the recent news on how many, I think 38 lakh weddings or 40 lakh weddings happening, and if you take the fair share of that demand into hotels, it's a very big business. With the improvement of the infrastructure like Bharat Mandapam in Pragati Maidan, or Dwarka, the Yashobhumi, or the Geo in Mumbai, when they are having events now, everything in and around is sold out. Now, these facilities never existed before. The same time, you can see all the airports getting extended. connectivity, because of this Udaan scheme getting easier and easier, this is going to fuel both rooms revenue as well as non-rooms revenue growth. But because we are very strongly driven by the Taj brand today, and Taj hotels have a lot of non-rooms revenue, this proportion will stay somewhere between 45 to 50%, but definitely not more than 50%. A lot of non-rooms revenue is very important source of the diversification of our top line that I spoke about.
Got it. And the other question, Puneet, I presume your hotel openings are on track, but I remember at the start of 2023 or midway through 2023, the conversation was that with the G20, with the World Cup and a few other things, the traction for the space is very large. Now, I know in recent conferences, you and some of your peers that have said that it was not, I mean, relative to the kind of growth seen, it was not so disproportionate that it will impact 2024. So therefore, my question really is, as you look forward to 2024, what are the key drivers which will drive growth for the hospitality industry and for IHCL in particular?
Well, in general, Neeraj, it will be fair to say that the supply cannot just come, out of nowhere. It takes time to get approvals to build hotels, and also, to build the infrastructure around it. So the supply will remain constrained, and based on some studies by some hotel consulting companies, the majority of the pipeline of supply is not in your key metros. It's as per Horwath, more than 50% of the pipeline of all companies put together is in non-metro locations. Now, your metros are key drivers of revenue and profitability, like Delhi, Mumbai, places like Rajasthan, Bangalore, Kolkata, Chennai. These are markets which are not seeing that kind of significant addition in supply. So the demand keeps outpacing supply. That's number one positive. Number two is G20 was a one-off event, but there are so many other events that are happening. There's so many other championships, from a Kho to a IPL for the seniors, and I don't know, all kinds of sports events which were not happening like that before. There are different conferences coming in because we did not have the possibility to host 3,000-4,000 people under single roof. Now that's also happening. The weddings are on all-time high and will stay like that. And I remain fairly optimistic that G20 was there, and actually I personally believe that G20 did a great for marketing India as a destination globally. It's not some kind of a tactical sale so that you immediately start seeing an impact in terms of foreign tourist arrivals. But over longer term, at least in the G20 participating nations, the destination India has got far more established than it was before. So I think we tend to forget that some of these things have a long-term impact on the business and on the sector, etc.
Mr. Chattwal, you've spoken about the demand-supply mismatch, and this is something that we're hearing from other industry players as well. I want to understand your plan and strategy to close that gap. How are you going to do that? Or, is the management segment also going to be a focus?
See, majority of our pipeline, which is today 85 hotels, so we are opening 2 hotels a month. We are signing almost 2.5 a month. And these contracts are management contract-driven businesses. Our guidance has been in 3 years to triple the amount of management fee income that we had, from 200 crores going on to 600. And that's something which we are very pleased about, and that is bringing the balance in the portfolio that we were looking for. 50% asset heavy, 50% asset light, going in a fast growth mode with all the brands, especially our new businesses. So all in all, I think this journey will continue of, even if we stop signing any new contract today, we'll be opening 2 hotels a month for the next 3 years.
That's quite a speed. Just one last point, Mr. Chattwal, your outlook for 2024, is it going to be driven as it has by domestic tourism? Are you expecting, inbound tourists to come back, and what is the kind of hike we're expecting in room rates?
Let me answer this in two forms. One is in terms of foreign tourist arrivals. We are still not at even 60% or 70% of where it used to be. So it's a big opportunity. And domestic is definitely driving, as India is seeing good GDP growth, good increase in per capita income. So I think that is going to definitely drive demand. And this, I would say, the new lust of the consumers to travel on longer weekends, which really started during COVID. So there is a shift in the customer behavior of people getting into their cars and driving off for a long weekend, whether they go to Uttarakhand from Delhi, or they go to Goa from the west, or they go to Coorg or Chikmagalur in the south, or or in the northeast. So I think that is a permanent shift. This is not going to change. The second important factor is that because of the supply constraint, demand should keep increasing. And it is not just next year. I can say with a great degree of confidence that hospitality sector is at the beginning of an upswing for next 3, 4, 5 years for sure, because this kind of demand we have not seen before. We saw it between 2003 to 6 or 7 on the domestic front, but that was because there was very limited supply. Now the supply is there, but it's only demand is growing faster. The second important when it comes to Indian hotels, for us, very big opportunity is our international assets. 3 of them, or let's say 2 of them in the US, are currently low performers because of what's happening in the US market. One of the assets is in San Francisco, and we all must have read or seen short videos on social media. So that's a big opportunity for us, because when they start coming back, they will further add to our robust top line, which is already diversified in a very strong fashion. So all in all, I remain fairly optimistic about the next year and beyond.
That's definitely an optimistic outlook, and that's why, Mr. Chhatwal, you're saying that you're on track to go beyond your guidance. Is that going to come from cutting costs, or more demand fueling it?
Our strategy has been to be most iconic and most profitable company from South Asia. That's the guidance we've given.
Yeah.
You can never be most iconic if you are only driven by cost orientation. So we spend where money is needed. Our asset management initiatives are driving our operating leverage. I would welcome everyone to go and see the relaunched Mansingh, the Taj Mahal Hotel Delhi, popularly known as Taj Mansingh, which we did on 30th of November. We have added some great facilities in Taj Lands End. We have added a new Chambers in West End, a new restaurant. So all this is adding cost, but it is driving more and more revenue, because all these initiatives are margin enhancing and also brand enhancing. So we get both the benefit of staying most iconic and also driving revenue, especially in places which were underutilized. When you're such a legacy company with such legacy assets, there is enough space that can be reimagined to create new sources of revenue and income. And that opportunity we have had in the last few years and have been able to demonstrate that.
Absolutely. We look forward to seeing the journey, because like you said, Taj has finished 150 years. So it is a great...
120, just a correction.
120 years. So it's a great company, but it's also an Indian icon. So thank you so much, Mr. Chhatwal, for speaking with us today on NDTV Profit.
Thank you.